Well, welcome everyone and good morning to the BetaShares Economic Outlook. How far will the RBA go? With the always insightful David Bassanese, our Chief Economist here at BetaShares, and myself, Chris Yates, a Director here at BetaShares. So we'll get straight into the presentation. Just some quick information. Please do take a read of this. Obviously, highlighting past performance is not indicative of future performance there. And anything covered today is very much general in nature and doesn't take into account anyone's personal circumstances. As always, these webinars will be recorded, so if you do miss anything, don't worry, the webinar will be sent out shortly after. And thank you all for those who already have sent through questions for David to cover today. We will have time at the end of the webinar to, of course, cover those. But do send more through as we go through using that widget box on the side there. Also, as always, I'd like to highlight that BetaShares, we have some fantastic content that you can follow. Jump on our website to find any insights on our funds, economic insights from David through his Bassanese Bites email that comes out on a Monday, and of course to keep across everything from new fund launches to existing funds. You can follow us either on Twitter, LinkedIn, and Facebook there. So a little bit about BetaShares and an update from our side. We're up to 75 funds now, so very much a growing space for us there, and we are again providing intelligent investment solutions for our Australian investors and always keeping that Australian-centric focus on what we do in terms of the ETF space. And we manage now over $22 billion here in Australia. And thank you all for your support. So David, in terms of his credentials of being our Chief Economist here at BetaShares, of course, he's responsible for developing those economic insights and portfolio construction strategies. He chairs our investment committee for our own SMA portfolios. Also, he was a former economist at the Australian Financial Review, senior economist and interest rate strategist at Bankers Trust and Macquarie Bank, and Treasury and OECD economist as well. And of course, he has written a book too, above all else. So do go on and have a look at that book there, the Australian ETF Guide, if you want any insights on building portfolios using ETFs or just general knowledge with the markets. So what are we covering today? An economic outlook from David, just covering across those broad macro policy outlook as well in terms of where we're at and some case examples of what happened in previous rate hike cycles with the Fed back in the late 60s and 70s and 80s. We'll be also looking at some financial markets, the S&P and where that's trading, and I guess some potential outlooks on the US market, and also just based on those macro and economic outlooks, what are some investment themes and ways you can position your portfolio with that in mind. So without further ado, I'll pass it over to David and I'll jump back in at the end to answer any questions that have already been sent through or as they've been sent through the webinar today. So over to you, David.
Thanks very much, Chris, and great to be with you all again for yet another update on what is, very, very interesting times in financial markets and with regard to the economy. So, yeah, going back a few years ago when we had the Great Moderation and nothing much was happening, interest rates were low and stable, inflation was low and stable. We've had tremendous upheaval in the past few years, and so I'll try as best I can to sort of give you a bit of an update in terms of where we are today and what the outlook is. So firstly, as Chris mentioned, we'll start off with the economic outlook. And this is first and foremost the most important issue, I guess, in terms of global markets, the fact that in the US economy, the world's largest, most important economy, many measures of inflation are at 40-year highs. As you can see there, the headline PCE is the consumption deflator that the Fed actually target. You also get a CPI in the United States measured slightly differently. CPI tends to have a higher level of inflation. So on that basis, headline CPI inflation in the US is running at 9%, but on this consumption deflator measure, running at just over 6%. Core inflation running around about 5% or so. Now, there are signs that that is, the worst is over potentially in terms of that increase in inflation. We have seen oil prices, commodity prices start to unwind over recent months. Now, as I'll get into in a minute, one of the issues there is that these are declining in expectation of a slowdown in economic growth. So you can't really, celebrate a peak in inflation and decline in inflation without also factoring in that, that's only happening provided growth does slow, or demand for things like petrol in particular, oil globally, does slow. But that is the situation. That is the big dilemma for global markets is, how quickly will inflation slow, and whether the Fed needs to generate a recession in the US, the Federal Reserve, that is, the US central bank, to get inflation down quickly enough. And again, the big issue in the US at the moment is, and globally in Australia, is that they're very concerned, central banks, with the longer we allow inflation to stay high, particularly in an environment where labour markets are tight, it can lead to a pickup in inflation. Well, the fear is that it leads to a pickup in inflation, wage price setting expectations, or inflation expectations, and feeds through into higher wages, which then feeds through into higher prices, and we kind of go back to a sort of 1970s level where inflation stayed at high levels for an uncomfortably long period. The other challenge in the US is that the unemployment rate, as in Australia, is very low. So the US payrolls on Friday had the unemployment rate tick down to 3.5%. Various measures of wage growth, running at historically high levels. And again, on Friday, we got the July payrolls report for the US, and it showed annual growth in average hourly earnings in the blue line there, remaining at pretty firm levels. So even if you think oil prices are coming off, commodity prices are coming off potentially, we're left with a situation where the US labour market is very tight, wages growth is uncomfortably high, which would feed through to inflation, all else constant. So to some extent, you need the US economy to slow just to take pressure off the labour market and take pressure off wages growth, which is the big challenge at the moment. Now, as in Australia, the US has started to raise interest rates, so they've gone from near zero at the start of the year to over 2%, and we are starting to see signs of a slowdown in the US. But the big debate is, is the US in recession or not? You may, if you read the media, there's been debates about whether it's my view is it's clearly not in recession. I mean, we got another very strong payrolls report on Friday, over 500,000 jobs created in the month of July. Underlying demand, underlying industrial production, certainly employment growth, are still positive at this point. I think ultimately the US may well have to go into recession to get inflation and wages growth down, but we're not there yet. But here's some early indicators. So the yield curve, so the spread between the 10-year and the 2-year yield curve in the US in blue has gone negative. It's been negative now for several weeks. And that's usually means the markets are starting to, longer-term bond yields in the US have fallen below shorter-term rates because the market is anticipating a slowdown in the economy, anticipating the Fed will eventually change course and have to cut interest rates. And usually when the markets get to that point, they're kind of sniffing out a slowdown down the track. And as you can see historically, whenever that yield curve has gone negative, within a year or so, the economy has typically gone into recession. Now, there's been some times where the yield curve has gone negative, and it's taken a long while for the economy to go into recession, but basically you've needed that yield curve to go negative. You've never had a recession in the US without that yield curve at least at first going negative. The other thing to look at is weekly jobless claims are starting to tick up. This is a very good leading indicator in the US. So look, they're still at incredibly low levels, but it is I guess an early sign that we are starting to see some softening in labour demand, which I think will start to impact on the labour market down the track. So that's a US situation. Very high inflation. The Fed have raised interest rates. We're hoping inflation slows quickly enough that the Fed can avoid. Basically, it's up to the Fed. If the Fed decide, we need to have the economy go into recession to break the back of inflation, then they'll do it. They'll keep raising rates and slow the economy. If they think that they don't want to do that, or they think inflation's falling quickly, they can change course. They can stop raising rates immediately and actually start cutting rates as they did in 2018, 2019. So really, the economy is in the hands of the Fed in this point. My base case, as I said, is I think ultimately, well, I might be getting ahead of myself, but I think the challenges are that the economy may well need to go into recession to get inflation under control, which is going to be a challenge for equity markets for the next little while. China's still living with, so elsewhere in the world, like unfortunately the story is not especially great either. So China's still trying to deal with a zero COVID strategy. And some of the reasons there, if you look at the first slide there, the intensive care beds per capita in China is relatively low by certainly Asian standards. And the other factor is that vaccination rates amongst the elderly remain quite low by global standards as well. So China remains quite vulnerable to an outbreak of COVID. I mean, if they did let it sort of learn to live with COVID, so to speak, they risk overrunning the hospital system pretty quickly, ICU beds, particularly given the low vaccination rate amongst the elderly. So there's not, ultimately you need to, let COVID go through the, you can't lock down forever, but at the moment they basically delaying dealing with this problem until after the leadership, major leadership meeting later this year, where the Premier will be reinstalled for another 10 years. So they're basically, China is in this limbo at the moment, waiting for the major political changes to take place later this year, or the Premier to be given another 10 years, and then they might have to sort of face COVID. But what we're facing is that in 2023, China's going to remain quite, a lot of risk, because they still haven't let COVID, course through the society in the way other countries have once they've got their vaccination rates up. Europe also having a lot of difficulty. This is a business sentiment indicator for Germany, and you can see that they have taken a tumble this year on the back of surging energy prices. And again, as you may know, the problem in Europe, particularly Germany, is that they jettisoned their nuclear energy capability in a transition to renewable energy. But in the meantime, they've started to rely more heavily on Russian oil and gas for their heating needs, their electricity needs. And I think Russia sensed the vulnerability of Europe to that. And it's maybe one of the reasons why Russia, with hindsight, thought it could invade the Ukraine and maybe get away with it. But Europe has been, I guess, morally obliged to impose sanctions on Russia, reduce its reliance on Russian oil and gas. And prices have gone up accordingly because they've had to rely on other sources of energy. And also they've had a lot of shortages because Russia's also started to restrict gas flows across into Germany. So business, so electricity costs have surged, energy costs have surged, and irrespective of what happens in the US, there's likely that the Europe itself will go into recession over the next few months, or particularly at least Germany. But if Germany does, it's probably likely the rest of Europe does. Meanwhile, I should point out that the European Central Bank only recently also raised rates by 50 basis points, even in a weakening economy, and that's because they're very concerned with high inflation. But in the case of Europe, particularly driven by high energy prices. But again, they are concerned about allowing inflation to stay higher for longer because of the flow through to expectations. So Europe, the European Central Bank is again raising rates even in the face of a weakening economy. So it's a sort of stagflationary environment, particularly in Europe at the moment. In Australia, good and bad news. So the labour market's very strong. As you can see on the first slide there, the employment number, unemployment's dropped down to 3.5%. Inflation has picked up. Look, unlike in the US, we're not seeing evidence of wage inflation in the official statistics as yet, but certainly things like housing construction costs, imported inflation costs have gone up. Obviously, petrol prices have gone up, and so that's added to inflation. And the recent forecast from the RBA and the government have inflation staying uncomfortably high, at least for the next couple of years. The economy, look, at the moment it's looking good, but the RBA is anticipating a slowdown in the economy through next year, and a bit of a lift in the unemployment rate through next year. So the RBA is not done raising rates. I mean, we have the cash rate at 1.85% now. I think they'll raise rates. So if they raise rates by another, 50 basis points, it'll take us to 2.35, and then another 0.5 after that will take us to 0.285, which is a little bit above what the RBA consider the neutral or normal rate. I'm thinking they won't need to take the rate beyond 3%. So I actually think they may well pause at 2.85%, or at most maybe after 2 further 50-point rises, another 0.15 thereafter. So we're talking about they will probably raise rates 0.5 at the next meeting in September, but thereafter they may downshift to quarter-point moves, so 25 points at each meeting. And so then you may get, 2 meetings of 25, which will take us to 2.85. And thereafter, I think they may well pause, or possibly do one more to go to 0.15 by 0.15. I mean, why 0.15? Just because it would round that interest rate back to around an even number of 3%. But again, I think, and you've seen the markets adjust as well. I mean, a few months ago, the markets are expecting the RBA to raise rates to over 4%. That's now come down to around about 3.5%. And I was saying at the time a few months ago, I thought that 4% was pretty unlikely. I still think on balance 3.5 is unlikely as well, because we are quite sensitive to interest rates. You can see here consumer confidence has already taken quite a tumble in Australia. The NAB business survey of sentiment is still okay. It's still, the economy itself is still chugging along nicely at the moment, enjoying the COVID reopening bounce. But certainly consumers going forward are very concerned, given the lift in interest rates and given, as I'll show in a minute, the weakening of house prices. So basically, just to summarise the Australian situation at the moment, the economy at the moment is going along quite nicely. It does, with unemployment ticking down to levels we haven't seen since the early 1970s. At this stage, at least, one good news is that we're not seeing a lot of wage inflation coming through, but that could change. But irrespective of all of that, we are facing a slowdown on the back of higher interest rates through next year. And given the already quite notable slump in consumer confidence, I don't think the RBA will need to raise rates all that aggressively to achieve the slowdown and the capping of inflation to the extent they want. And just on that, as I mentioned, wages growth, you can see here surveys suggest it's very difficult to find staff in Australia. But at the moment, at least, and again, this measure is only up until the March quarter. It'll be very interesting when the June quarter number comes out. But the wage price index in Australia is still running, as at March, at only 2.5%. But there is some that could pick up to say 3.5%, and that would still be consistent with long-run inflation in the RBA target of 2 to 3%. So even if it does start to pick up over the next couple of quarters, as I do anticipate, there's a long way to go before it would reach a level that we would be concerned about. Certainly concerned to the extent the US is concerned with very high wages growth. The other thing that I think will limit, the degree to which the RBA raises rates and the degree to which the economy may well slow through next year is we are seeing house prices, slowly but surely roll over. So this is just the latest update from CoreLogic. So in Sydney, as you can see, over the past 3 months, you've had an almost 5% decline in prices. Nationally, it's a 2% decline in prices. Look, I've long maintained, I think that people are, how far house price, no one can have a precise estimate of this. Historically, in fact, I'll go to the next slide. If you look historically, the first chart there, these are the declines in house prices nationally using the ABS measure of house prices. And you can see nationally, we had 2 corrections of about 5%, earlier last decade. and more recently we had a correction, not quite 10%, but just over, certainly over 7.5%, and that was driven by a big decline. I just flipped to the Sydney market here. So this is Australia median house price, and this is Sydney. So focus on the top left chart here, and you can see in Sydney a few years ago we had a more than 12% correction in house prices when the APRA and the RBA imposed macroprudential controls and asked the banks to raise rates on investor lending to rein in credit growth for investors. So, and as you can see, Sydney have had a number of periods of house price weakness, but nationally we've had not quite a 10% decline in recent times. I think, you know, we only have just begun, but given the already, if you look at mortgage affordability in Australia, it's not particularly great. Even with the RBA having raised rates so far, we've got mortgage repayment ratio on average for households. So this is like an average measure of the affordability of taking out a mortgage to buy a medium priced home. It's already a little bit above average. And if the RBA were to raise rates up to 2% or another 200 points, I don't expect that, or even 300 points, as the market was once expecting up around these, you would see it would take affordability unaffordability to the worst levels, at least since the early 1990s. So that would definitely have a material impact on house prices and on the economy, which is why I don't think we'll get there, because I think we'll get a slowdown well before that happens. But look, overall, I mean, I think we'll get at least a 10% decline this time around in national house prices, so a bit more than what we got last time. I mean, many people talk about 20, 30%. I mean, look, if we had a massive breakout in inflation on a sustained basis and the RBA had to raise rates up to 5, 6%, you know, something crazy like that, you would get a deeper correction in house prices. But on my view that the RBA is going to raise rates to about 3, I don't think you're going to get that deeper correction in prices. Just in Sydney, so that's the national average situation. If you look at Sydney, you can see mortgage affordability in Sydney is already at pretty bad levels, even midway through this RBA tightening schedule. So in terms of where most of the house price adjustment will come, it's going to be in these very expensive cities such as Sydney and Melbourne, in particular, Sydney in particular. It should be contained. This is a lot of analysis by the RBA, and again, another reason why I don't think we're going to get a major house price correction. Well, major, I say more than 20%. Most of the debt is owned by those in higher income areas. If you look at the distribution of household debt, is the point one. And the other point here, if you look at this slide, 1/3 of these are only, so a couple of points on the impact of rising interest rates on households. Firstly, 1/3 of households don't have a mortgage. They're either renting. 2/3 of households don't have a mortgage. 1/3 are either renting, 1/3 are renting, and 1/3 have a house, but they've fully paid it off. And so we're talking about 1/3 of households do have a mortgage, and of those, roughly 1/3, or just under 30%, will face a increase in repayments of more than 40% with a 300 basis. So if the RBA were to raise rates to 3%. So we're talking about 1/3 of households facing a pretty significant 40% increase in repayment. So there is some pain definitely for households, but it's from an overall perspective, it should, from a macro perspective at least, it should be manageable, because most should be able to handle that increase in repayments. So that's from again, I don't want to underplay the challenges that there will be for some households, particularly that have taken on big mortgages late in this cycle. But in the main, all the analysis from the RBA and whatnot suggests overall it should be manageable. And just this other chart here, if you look at the household debt, household credit to income ratio, that's what it is. And then if you take off the fact that a lot of that lending is being, they take out mortgages, but they've paid it down and it's in offset accounts, it's somewhat less than that once you allow for the holdings of offsetting assets in their sort of offset accounts. So that's just a lot of analysis to suggest, the RBA's looked very carefully at this and thinks it should be somewhat manageable. In terms of financial markets, this is the challenge, is that the Fed and central banks around the world don't want to repeat the mistakes of the 1970s. And by that I mean, these are periods where the Federal Reserve in the US was raising interest rates. And you can see they stopped raising rates in the early 70s as soon as the unemployment rate started to go up, even though over this period inflation was still rising. So they basically reacted to the lift in unemployment and stopped, even though inflation was rising. And as a result, inflation tended to ratchet up over that time. And it really was in the 1980s when, if you look at it, they were raising rates in this grey area, even as unemployment rose, because inflation was still rising. And it was finally the recession and the further surge in unemployment that broke the back of inflation. And it started to fall. So the Fed did stop raising rates once inflation had peaked and started to come down in the early 1980s. But it was only as it was clear the US was going into recession and the unemployment rate was rising. So ideally, we don't want to repeat the early 1980s, but they say the risk of having to do something like that increases if we don't tackle it quickly. So this is the challenge for the for the Federal Reserve at the moment, is they don't want to stop. There may come an uncomfortable period where inflation remains uncomfortably high, but the unemployment rate is starting to rise. Now, will the Fed quickly change course and start to at least, not only, stop raising rates and may even start cutting rates? Because if they did, then they could entrench a higher level of inflation. So it's a race against time, whether if inflation can fall quickly enough, the Fed can pivot and we can avoid a recession. But if it takes a while to come down, as I said earlier, the Fed won't pivot anytime soon, and it may actually need to tolerate the economy having a period of recession just to get inflation under control. And some of the reasons that I think it's going to be a challenge is, firstly, the oil market. These are projections for the oil balance in 2023. From the International Energy Agency, and you can see that on demand projections a couple of months ago, you're going to have a deficit of oil because the oil supply is pretty flat, and with an ongoing global recovery, you're actually going to get to a period where demand exceeds supply. So yes, oil prices have come off at the moment, but they're coming off in anticipation of a slowdown in demand. If you didn't get that demand slowdown, we all started celebrating the Fed won't be raising rates anymore, and the economy won't go into recession. Problem is that oil prices will probably back up pretty quickly. Also, food prices. Look, food prices have come off as well. But one of the reasons that food around the world prices have been high is that it's not just Russia's invasion of Ukraine. There's been disruptions around the world to growing conditions due to poor weather conditions, and the Southern Oscillation Index measures La Nina versus El Nino effects. And so, without going into it too much, once this is a measure of water temperature differences between Darwin and Tahiti, effectively. When it's up at these levels, it means we're facing a La Nina period where it's very wet conditions in the southern hemisphere, hence our flooding, but very dry and drought conditions in the northern hemisphere, hence a lot of bushfires and droughts in the United States, which is disrupting food production. And that measure at the moment is saying that sort of La Nina weather pattern may well persist for some while longer. So that is going to remain hazardous to the food market. In terms of policy, so the good news is that the markets have started to price out some of the expected tightening by both the Reserve Bank and the US on the back of a slowdown. As I said, the black line here is the market's expectation of the cash rate 12 months into the future. And a few months ago, they were expecting it to be over 4%. It's now come back down, in fact, just over 3%. And in the US, it's come back. Actually, it's similar in both markets at the moment. They're expecting a cash rate of around about 3% or so. I think the market, I actually think it's reasonable value in Australia, but I think the market may be a little bit overly optimistic in terms of the Fed. I think the Fed will go to at least 3%, may go up to 3.5%, but I don't see the RBA going that far. And just on that, I mean, as I said, these are the differences between the Fed have been able to have, this is the US federal funds rate and periods where it's raised rates and caused a recession. and periods where it's avoided having a recession. So there are periods where the Fed can raise rates and avoid recession. The late 60s was an example, the mid 80s, the mid 90s, and 2018, 2019. But in other periods, it's raised rates and caused a recession. So soft landing is certainly possible, but as I would argue, it's really up to the Fed, and it does just come back to the inflation outlook. And he said soft landings have usually happened where you've had no material increase in the unemployment rates. If you go back to this slide, these soft landings, i.e. periods where we didn't get a recession with the Fed raising rates, have been periods where the unemployment rate basically didn't go up. You can see here and here. Obviously, COVID, it went up during COVID, but the periods where you did cause a recession is where the tightening did lead to an increase in the unemployment rate. And just on this slide, you can see that it's very hard to have a minor increase in the unemployment rate historically. So you can see every time the unemployment rate in the US has gone up by at least 0.5%, you've basically gone into recession in the US, and it's never stopped there. So the idea that you can fine tune this and maybe get the unemployment rate going up just 0.5%, and that might just take the edge off growth by enough without causing recession, that's why they talk about this very narrow path, because it's been very hard to do historically. Once you've allowed that unemployment rate to go up over 0.5%, it's typically tipped the economy into recession. And if you go back to that earlier slide I had of wages, given the wages in the US at the moment, the very low unemployment rate, they probably do need to get that unemployment rate up. But as I said, to get it up and have it only go to say 4% and not end up going a lot higher is a very difficult task to achieve. In terms of financial markets, look, some good news is that the bond market, as I said, the market's priced in very aggressive policy tightening. Now they've priced some of that out, but I think the worst case, particularly in case of Australia, is probably priced. So we're seeing bonds performance. We had a major underperformance of bonds relative to cash over the course of this year on the back of this, sharp increase in interest rates. But I think that's now starting to level out. So with bond yields in Australia peaking, I think bonds will no longer, significantly underperform cash or significantly underperform in their own right. Straight equity market, a bit more challenging. You can see here the US market's had a PE correction. We've actually had a bit of a rebound since mid-June with the peaking of oil price and interest rates. And that's caused the PE ratio to go from under 16 times earnings back up to about 17.5. But the problem is that if the economy does go into recession, the PE ratio typically falls ends up at a lower level than where we are at the moment. And also we get a more substantial decline in earnings, which haven't yet come through. And you can see that on this slide, the PE ratio in the US, these are periods of recession. So in periods of recession, the PE ratio has typically gone as low as 10, but around 12 to 14. So I think if the US does tumble into recession, this PE ratio will probably need to go lower. But most importantly, earnings growth will also need to weaken. And at the moment, earnings growth is a bit disguised by this chart, but this orange line is running about plus 10. But if the economy does go into recession, that's probably going to tumble to minus 10, minus 20. Again, the average decline of the US market in a recession has been about 35%. At its lows, back in June, the market was down 23%. So again, my base case is that the US will probably need to go into recession over the next 3 to 6 months. And as a result, we probably haven't seen the lows in the equity market. Aussie dollar going a bit lower too on the back of a global slowdown and weakness of commodity prices. It has broken, it's flirting with this 70-cent level. It got as low as 68 cents recently, but again, over the next 3 to 6 months, if I'm right about the slowdown in the US economy in particular, I think it could go as low as 62, 63 cents. Because again, Australia, the Aussie dollar is seen as a global growth currency. So if growth slows, commodity prices weaken, and we may see iron ore prices continue to weaken in that environment. That's not going to be helpful for the Aussie dollar. Just in terms of investment themes, this is interesting. This is the relative performance of growth versus value. So these are companies on high PE ratios globally versus companies on low PE ratios. So this is usually the technology, consumer discretionary area. These are financials and energy stocks, and you can see that value has basically been enjoying a broad period of outperformance since the lows of COVID, and since the basically interest rates bottoming in mid 2020 and rising, and that period of outperformance. Well, it had a period of outperformance in late 2020, let's be specific. Then it went sideways over 2021 and had another kick higher this year. And it's been correlated with the trend in bond yields. But if, as I think bond yields are sort of close to peaking out here, then the underperformance of growth, at least relative to value, I think may be bottoming out as well. Now, that doesn't mean that growth stocks are going to start rallying. All I'm saying is that relative to the rest of the market, this period of underperformance may be behind us. Some of the, and by growth, I mean, just focus here on the growth areas, the technology, ATech, NASDAQ, robotics, hack. These are the things that have been absolutely pummeled by the increase in interest rates since late last year. They are now looking relatively better value. And again, we're not there yet, but when we get through to the other side and we go back to a low inflation, low interest rate world, I do think these are going to be the areas of the market that start to outperform again. And relative to the rest of the market, their period of underperformance may have bottomed out. Look, in the interest of time, I'll just switch to just a couple of other points that I want to make sure I conclude with. Look, in terms of the equity market at the moment, if I'm right and there's a bit more weakness to come, then where investors tend to gravitate to is the more defensive sectors. So another way to split the market up is not just between growth and value, it's cyclical versus defensive. And cyclical are basically sectors like technology, like consumer discretionary, like resources, which have a high beta to the markets. When the market's doing well, they tend to outperform. Defensive areas like consumer staples, healthcare, infrastructure, utilities, these are areas that at least when markets are weakening, don't tend to weaken as much. So they're seen as a more, and you can see here, defensive sectors have been outperforming with the pullback in markets of late. And basically, to the extent you're looking for a tactical theme in equity markets at the moment, it's to look at defensive sectors like consumer staples. With an ETF, one that we have is INCM. It's a global high income ETF that has a lot of utilities and infrastructure in it. It does have some energy in there as well, but it does have a bit of a defensive, more of a defensive skew than some other areas of the market. Look, I'll just go. The other thing I wanted to conclude with, and I said, this is a snapshot of the relative performance of a lot of our ETFs relative to, in the case of Australian ETFs, relative to the ASX 200, and in the case of global ETFs, relative to the MSCI All Country World Index. A couple of points to note. Firstly, if you look at resources and energy, they had that, when we had the increase in inflation, Russia's invasion of Ukraine, we were talking about the inflation trades earlier this year, and they certainly did well. But as you can see, with the peaking of oil prices and the unwind of interest rates midway through, basically as global concerns have shifted from interest rates and inflation to the impact of higher interest rates on economic growth and the potential slowdown of the global economy, these inflation hedge trades have started to unwind. And so I think that was a trade for earlier in the year, but it's probably not a trade going forward. You can see technology have started, their relative performance is starting to bottom out. So here's a couple. So drug is global healthcare, which has been doing well. And I think in a down market, that could be an area, again, along with INCM, as I pointed out before, that may be an area that at least outperforms relative to the broader market because it is sort of defensive in nature. The other, one of the good news aspects here is that at least with the increase in, if you've been owning bonds over the past 6 months, of course you've had negative returns. As bond yields go up, the value of bonds goes down, and so you've had negative returns on fixed income funds, and many of our fixed income ETFs have also had negative returns. I guess the upside is that now they are offering a decent yield. So if you're wanting to, if you have them and you keep them now, the prospective income returns relative to their market value have increased. And if you go in and buy bond funds now, you are getting certainly more attractive yields than was the case a year ago. So things like long duration corporate bonds now offering a prospective a 1-year income return of just under 6%. This is cred. So that is corporate bonds. So it has a lot of credit exposure. You can see here, I've split out the yield, the prospective 1-year returns with some of their risks. So credit duration means it's sensitive to a widening of credit spreads. So if credit spreads, you know, the yield on corporate bonds versus government bonds widens out, then that tends to reduce the value of these bonds. So it shows you the sensitivity of these bonds to credit spreads. And this one shows you the sensitivity of bonds to interest rates, generally speaking. So AGVT, for example, has a duration of about 8, which means if you get a 1% increase in interest rates, so a 100 basis point increase in bond yields, that would tend to reduce the value of that by 8%. So it's very sensitive to interest rates. But because of that sensitivity, it's giving you an attractive yield. And here's cred. Doesn't have quite as much interest rate exposure, but it has more credit exposure. But the net effect is it's offering you an attractive yield. Now, for what it's worth, I think, as I said, if you think bond yields are peaking out, broadly speaking, then the interest rate duration risk has certainly lessened. So I don't anticipate further negative declines in bonds due to major increases in interest rates. So getting yield from duration is certainly attractive. Credit spreads could widen a bit further if we do get a slowdown. So, but again, something like credit is offering an attractive interest rate that would compensate to some extent were credit spreads to widen out. But that just gives you a taste of lots of the different income yields you can now get from our fixed income ETFs. These are the codes for the ETFs, and also our hybrid funds. So we've got our actively managed hybrid fund. Again, the beauty of hybrid, as you can see here, and BHB, which is our indexed hybrid fund, is you're not taking on any interest rate duration. So if interest rates generally go up, the capital value of those bonds, of those hybrids, won't go down, and you're getting a nice, attractive interest rate pickup. But they do have some credit spreads risk. So if credit spreads widen, that will tend to undermine their returns somewhat. But that is the the risk return, the way to think about the risk return of those different exposures. That's it from me. I will leave it there and open it up to questions.
Excellent. Thank you so much, Dave. And we've got a stack of questions, so we definitely got enough time to cover, I guess, a good portion of those. The first one here, and we've got a couple in terms of just looking at Europe and particularly Germany. There's one question that came through in terms of if Russia were to cut off, the gas supply into Germany, and I guess broadly speaking, from what you view in the European economy there, what's the sort of net effect of that in terms of the global economy and Australia as well? On the caveat say that the US doesn't go into recession.
Yeah.
Does Europe pull the global economy into recession?
Yeah, look, good question. And look, those that have listened to me in the past know I focus a lot on the US because the US, does drive the global economy. So I would argue if Europe goes into recession but the US doesn't, equity markets probably won't fall a lot further. I don't think the global economy would go into recession if it was just Europe going into recession, nor do I think the equity markets would fall a lot further. It's more important whether the US goes into recession or not. But if so it's really comes down to the US question. So it doesn't help, but the margin Europe ailing under the impact of energy prices certainly doesn't help, and it makes the global backdrop even worse. But in and of itself, if US avoids a recession, if inflation starts to come down quickly and they can avoid a recession, then the troubles that Europe are facing, I don't think will be enough to sort of hit the equity market. But if you're talking about Russia, I mean, they have really cut back on their gas supplies. They're really holding Germany's feet to the fire here, because as I understand it, the pipeline that provides the gas into Germany, they've cut the supply back to like 20% flow. because they're arguing it's maintenance and whatnot. So they're really putting the Germans under a lot of pressure. And Germany are now frantically trying to reopen their mothballed nuclear reactors to try to asking households to limit the extent to which they use heating and all this sort of stuff. So there are, a lot of difficulty at the moment.
Excellent. So there's another question here, and just in terms of what you covered of those lessons from the 60s, 70s, and early 80s there, in that chart, which is the US core PCE, it shows, I guess, where we're at now, and there's a slight drop in terms of inflation, which, a touch under sort of around 5% there. When comparing that to those other scenarios where it was sort of peaking around 9 and 10, what are the differences in terms of how actually inflation was calculated then to today? Why is that, I guess, so relative to what we're looking at in today's markets?
Look, it just again, I didn't make note of this in the presentation, but if you look at this chart, you can see that inflation at the moment, yes, it's higher, but it's not as high as it was in the 70s. But as some economists have pointed out, the way in which they measure inflation today is different than what they did in the 70s, and particularly house prices have a less direct impact on on inflation compared to the past. So back in the 70s, the value of house prices, actually had a pretty direct impact on the CPI. So if house prices went up, it sort of had a direct impact. Whereas today, it's more indirect through rents. And so they really measure the impact of housing costs on the CPI through rents. And the bottom line of that is that a given increase in house prices has a less impact on inflation than it did in the 70s. Now, if we were to calculate inflation today, or basically two ways to think about it. If they calculated inflation back in the 70s the way we calculate it today, inflation generally in the 70s would still be high, but be lower than what it is today. So inflation today, or vice versa, if we calculate it based on the way they did in the 70s, inflation today would be a lot higher because the US has had a house price boom through COVID. So these numbers actually underestimate the challenge of inflation in the US at the moment. These numbers are actually properly measured. Inflation today is even higher than it was during the 70s.
Excellent. And just another one on this, we've got a question here coming through from Dacian. Was inflation in the 70s driven by a wage push, where today we're seeing it's been driven by, I guess, a cost pull? Any thoughts on that?
Yes and no. Well, look at this is wage inflation in the US today. 3 measures of wages, and they're clearly going up. So it's not. Yes, there's been some oil prices have been a factor. So there's two challenges in the US. One is the impact on the CPI of just very strong demand, Russia's invasion of the Ukraine, supply chain bottleneck. So the direct impact of things on the CPI. But the other challenge is that even if those things come off, at the moment you've still got a very tight labour market and wage inflation running at very strong levels, and which even if oil prices come off, that's going to feed through into service sector inflation. So it's similar to the 70s. In the 70s, yes, unionisation was stronger back in the 70s, and so it was easier to get wage inflation, wages increasing. But today the labour market is just so tight that workers do have strong bargaining power. So with or without unions, people are switching jobs, going where they can get higher wages, and that's what's driving it up at the moment.
Excellent. And I guess while we're on US wage and this slide here, there's a question in regards to, what is the level that's needed to prevent, prevent wage inflation, and can that wage inflation issue be overcome by immigration, both here in Australia and the US?
Yes, it could. And so one of the issues in the US, I think immigration basically has been a sort of safety valve on the labour market in many developed countries in recent years. And so we've obviously had very high immigration, high skilled migration, which has helped keep a lid on inflation, although many policymakers don't want to admit it. The Reserve Bank has effectively admitted that in the past. And in the US, there's been some policy changes that have tightened up on immigration. So immigration has certainly slowed by a lot in recent years in the US, and so that has made the labour market tighter than it would otherwise be. But there's not a lot of appetite in Washington, for example. In Australia, we are going to go back to a high immigration world once people are happier to travel and move again. Once the COVID issues settle down, we're still in the early stages of renormalising immigration. But both sides of the political spectrum in Australia favour high immigration, for good or bad. That's what they favour. So that will eventually help to limit the wage sensitivity of the sensitivity of the labour market to wages. But in the US, there's not a lot of appetite to boost immigration. There's been a bit of a conservative backlash against all of that. So that doesn't look like changing anytime soon. So yes, it could, not in the near term, and in the US, probably not in the longer term either.
Excellent, thank you, Dave. There's been a few questions around your views on gold, both in terms of an inflationary hedge and obviously in the case of a US recession.
Yeah, gold's been a tricky one. Look, and again, if you've been following my stuff over the last few quarters and through COVID, I've had a pretty mixed view on gold. Like, gold has done okay. It hasn't done fantastically. And I'm just trying to find, we do have something about gold. Yeah, QRE. These are sort of what we were talking about in Q1. Food, fuel. When commodity prices were rising and we were dealing with high inflation, and gold was certainly in the mix there, QAU. But again, in the US, basically gold didn't benefit that much from the pickup in inflation because the central banks did turn hawkish quite quickly. So you had rising interest rates, strong US dollar, which undercut the appetite for gold. And now if you go into a global slowdown, gold's probably going to come under pressure because it does tend to weaken in a global slowdown. But gold may come good again when the Fed pivots, when the Fed actually says, okay, enough's enough, it's time to start cutting interest rates, and the US dollar weakens. That's when gold may have its best returns. But that won't necessarily be an inflation hedge. It'll just be more a reaction to lower interest rates. And to be honest, when we get to that environment, yeah, you can buy gold, but I'd be buying equities even more so. But bottom line, if you do, I mean, the big issue over the past 6 months is that yes, inflation has picked up, but central banks have turned, they've responded to that in a very hawkish manner. By raising rates aggressively and saying we're not going to repeat the mistakes of the 70s. So that's fundamentally why gold hasn't, shot the lights out here. Had they not done that, had they basically said, oh, we think inflation is going to be temporary, it's going to remain temporary, we're not going to raise rates, then gold would have done a lot better.
Excellent. There's a question here just in regards to if the US are forced to raise rates and indeed push the US economy into recession. Obviously, from the last recession we went through, and COVID being one of the shortest and sharpest in history, what's your view of, I guess, how long this one is? It going to be more of a traditional recession like we've seen in the past? Yeah,
I think this would be more like a garden variety. The important thing, this will be a recession caused by a need to get inflation under control. It won't be caused by like a financial market bubble that blew up. So like the GFC, for example, and even 20 years ago, the dot-com bubble, where we had a major bubble in tech valuations, a major bubble in technology spending, because again, those of you old enough to remember, we had a Y2K concern at the turn of the century. We thought all the computers were going to not work in the new century, and there was a lot of spending on dealing with Y2K, and ended up being a complete fizzer, and so that investment unwound pretty quickly. But bottom line, if it's really just raising rates and you slow the economy to deal with inflation, then as inflation comes back down again, the unemployment rate goes up. You can then ease off the brakes and have the economy have a recovery. The main thing is you've gone through that period to keep inflation expectations in check. If you've done that, then you can let the economy rebound again. So the average length of a recession in the US is about 10 to 12 months, and I would anticipate something like that. Maybe even on the shorter end, maybe 8 to 12 months, because I think it won't take that long, I think, to get inflation back under control. So it's more like the recessions we saw in the 50s and the 60s, where inflation picked up, central banks raised rates, and you did get a bit of a correction. So that'd be my view. I don't think it's going to be as deep and drawn out as, say, the GFC.
Perfect. And if the US does go into recession, can we rely on something like China to drive, I guess, resources through here in Australia to avoid a recession and go through, a resource super cycle? What's your thoughts there?
Look, China, the problem with China is it's still dealing with COVID. So it hasn't, most people in China still haven't had COVID because of the lockdowns and whatnot. So that is a band-aid they need to pull off at some point, which is going to, I think, lead to a lot of disruption in that economy through 2023. So the hope that they could, stimulate the economy and lead to a massive increase. So that's point one. Point two is, yes, even if they didn't have a COVID problem, they could, do yet another infrastructure package, allow local governments to spend even more on allowing property developers to build high-rise apartments or build new railroads and whatnot. But they're really starting to strain their capacity to basically have debt-fueled, top-down infrastructure and property development. As we know, the property sector in China is ailing at the moment. They basically had a bubble in high-rise property development, building too many properties that people wanted to have for investments, but they didn't have the people to put into those properties. And so, what do you do when you're in a bubble? You can't just keep inflating the bubble, or maybe you can. But so, look, bottom line, I don't see it offsetting, simply because of COVID, but even because of that, there may be question marks. China needs to ask itself the question: is it going to continue to do this, debt-fueled, inefficient, resource-intensive type of growth, or sort of switch to focusing on a more services, consumer-led type growth, which is what we'd all been hoping for, but they haven't really managed to achieve that in the past 10 years or so. But bottom line, no, I can't see it being an alternative source of growth, particularly if the US goes into recession.
Perfect. And again, we've got one more question that we can probably get before 12. And just quickly, your thoughts or views or outlook on the Aussie dollar versus the US dollar.
Yeah, so as I kind of alluded to in the presentation, if the US does go into recession, commodity prices weaken, people become very risk averse, and the Aussie dollar tends to weaken in that environment. So, and I think also that the RBA will eventually not raise rates as aggressively as the Fed. So I see the Fed going to 3.5. I see the RBA going to three at most. So that interest rate differential will hurt us as well. So bottom line, I see it going lower from here to the low 60-cent range.
Fantastic. Well, thank you all for joining us today, and thank you, David, for covering that and all those questions. Again, just to cover quickly on the slide, the investment risk, no guarantees. Again, general information was provided today, and we always do say to seek professional advice if you're looking to invest. Of course, this will be recorded, so if you've missed anything today, that'll be sent out shortly to you. But thank you so much for joining us.
Thank you. Bye for now.